Welcome to the Carry Trade video blog. The original blog is on our website in the General Forex section if you'd like to read it. The carry trade is an interesting and very attractive strategy to some traders. It was very popular with large hedge funds, individual retail traders, and every size organization in between. Its popularity has grown and declined over the years. With dynamic economies and changing currency interest rates, opportunities to play currencies against each other to cash in on the difference between interest have provided passive income to those who know how. The interest paid to you from the bank, or you to the bank, is also called the swap rate, or rollover. Whatever you want to call it, it's all about the interest of each currency. Every currency in the world has an interest rate associated with it, depending on whether you're buying or selling it. Check out the sample listings of interest rates from a typical broker. Notice that some rates are positive when you are long and negative on some, and the same goes for when you short a currency pair. This dictates what direction you would want to be trading that currency pair in order to capitalize on the difference in interest. Okay, back to the original question. What is the carry trade? Simply stated, it is a trade where a trader opens a position where one currency has a high interest rate and finances that trade with a currency with a low interest rate. This difference in interest is captured only one time during the trading day, when the market closes at 1700 hours New York time. Let's go back to our list. Did you happen to notice that many pairs are negative both long and short? That means no matter what, you cannot capitalize on the interest of that pair. So let's get rid of those. Now we have a list of currencies where one direction has a positive interest rate. Some great examples in the past were the Great British Pound Japanese Yen, the Great British Pound Swiss Franc, and the New Zealand Dollar Japanese Yen. As a matter of who sets the interest rates, that responsibility is left to the Federal Reserve in the United States, the Bank of England in the United Kingdom, and the Bank of Japan, in Japan. There are other currencies specific to particular countries where their banks set the rates, but we'll stick to the major pairs for this conversation. Let's roll the clock back a bit, when the carry trade was a mainstay of many traders. We'll look at the New Zealand Dollar Japanese Yen for our example. Back in 2005 to be exact, the New Zealand economy was smoking hot due to heavy commodity demands from China and a concurrent housing boom. We saw bank lending rates reach 7.25% and stay there, while Japan's lending rate stayed at 0%. So the difference between the two rates was a positive 7.25%. In this instance, a trader would buy or go long on the currency with the higher rate, which was the New Zealand dollar, and sell or go short on the currency with the lower rate, the Japanese yen. Now the math. Since there is a differential of 725 basis points, and since we can trade the Forex market with leverage, we'll assume an ultra-conservative leverage of 10 to 1, meaning you can control 10 times that currency pair with 1/10 the cost, or $1,000 controls $10,000 of currency, and that equates to a massive 72.5% annual return just on the interest, not including any profits from the trade itself. This is why the carry trade was so popular. But there is a potential downside to this. Even though the interest can yield spectacular gains, the movement of the pair goes both ways. Since you'd be long in this trade, a decrease in the price of this pair would present as a loss, affecting your interest gains. This provides us with a time horizon-based goal. The longer investors who see a long-term rise in the value of the New Zealand dollar would reap profits, while short-term traders who may only hold it for a few days could potentially see losses. Before we get back to the current swap rates, I'd like to tell you a true story and how it played out. There is something called Triple Interest Wednesdays. This is a weekly occurrence where interest settles on an open trade at 1700 Eastern Standard Time like normal. However, on Wednesdays, it pays 3 times the interest to account for trades held open over the weekend, hence Saturday, Sunday, and Wednesday. And it still happens today. This provided a very short-term opportunity that we try to take advantage of. Okay, so picture this. We gathered around our computers at about 4:30 Eastern Standard Time and had the pound yen, our then current favorite, up on both the 1-minute and 5-minute charts. The spread was a bit wide, about 10 to 15 pips, given the fact that it was nearing the end of the trading day, and a few other blokes on the planet were engaged in the same shenanigans. We watched each candle form, looking for the best entry where we thought price might find a low, and then continue up on momentum as we marched on till the end of the trading day. Usually, between a quarter till and 10 till the hour, we made our commitment, held our breath, and pressed the button to buy as much as we dared, stops be damned, and white-knuckled the table watching each tick move the 1-minute candle in small spurts or hang until it decided to move again. Right at the stroke of 1700 hours and 0 minutes and 0 seconds, everybody pounded on their keyboards to get out of the trade. If timing was on your side and momentum carried the price up, you covered the spread and collected your triple interest, satisfied with a job well done. And maybe you made a few pips on the trade itself. If you didn't get out in that magic second, price usually dumped as the masses were all trying to get out, and by the time slippage set in, your trade loss eclipsed the interest gained, the agony of defeat. But I noticed that more often than not, through backtesting, that the day's momentum would carry the price higher that evening, even though the 1700 sell-off would depress the price level. So on those occasions where I was not fortunate and did not get out in time, I resorted to a conventional trade setup and placed a stop loss and take profit, and life went on. So, the big question remains, could you do it today? Yes, you could, but the interest rates have to yield a net positive. Let's go back to our spreadsheet. Even though there are pairs that are positive in one direction or the other, the net between the long and the short in all instances is a net negative, meaning that in the current market, at the time of this blog, the carry trade would not work. Perhaps in the future, when banks change rates, the opportunity will revisit us. There are other similar strategies that are termed trading baskets or arbitrage, which involves trading groups of currencies with varying degrees of correlation. However, we'll save those concepts for another blog. Be sure to sign up for our email digest to receive advanced notification as we continue to publish relevant Forex material that you can actually use in your everyday trading. If you're new to our channel, be sure to hit the subscribe button to be notified each time we post a new video blog and give us a like. Of course, come see us at www.stonehillforex.com and explore our website. We're also on Facebook, so be sure to like us to get notified of new posts. Discover a world of Forex information all in one place. Our only goal is to make you a profitable trader.
Any information communicated by Stonehill Forex Limited is solely for educational purposes. The information contained within the courses and on the website neither constitutes investment advice nor a general recommendation on investments. It is not intended to be and should not be interpreted as investment advice or a general recommendation on investment. Any person who places trades, orders or makes other types of trades and investments etc. is responsible for their own investment decisions and does so at their own risk. It is recommended that any person taking investment decisions consults with an independent financial advisor. Stonehill Forex Limited training courses and blogs are for educational purposes only, not a financial advisory service, and does not give financial advice or make general recommendations on investment.